Welcome to another episode of the Financial Armor Show. My name is Jose Rodriguez, investment advisor here at Cooper Financial, and your host for today, alongside my co-host Jaclyn Gladhill. How's it going, Jaclyn?
I am amazing. I'm on this high. And
Mm-hmm.
Jose, we just shared why, but I'll tell our listeners that I happily got engaged this weekend. And so
Congratulations.
thank you. It's an experience it's a high. I mean, honestly, I don't
Mm-hmm.
even know how else to explain it. And it's exciting.
Yeah, and you did it. Well, he did it at a where'd
Apple
you do it?
orchard.
Apple Orchard. Yeah, that's awesome, and I
Well,
wish I could think of something like that whenever I pop the question to my girlfriend. I just hope it's magical. I'm just super nervous that it's just never good enough. I don't. That is, I
yes.
feel like that is every man's concern.
Oh,
We just want to do the
absolutely.
right thing, but we're just not wired thinking
Yes.
that creatively, or at least I'm not.
Yes.
So
No,
that is.
and it was unbelievable. So, I mean, he planned a photographer, and I think it's also so different now. I mean, not that my expectations are like really high, but it's just different how people propose now. And, it's like a big deal. And
Yeah,
so
yeah.
he got a photographer and also surprised me with my friends and his friends and family, and he did ask for permission from my parents. That was a need, that was a must have for me.
Yes, 100%, 100%. So when's the wedding?
We have no idea. I am already so overwhelmed with all these decisions. And he, of course, because he put this all together, he thinks that he's off the hook now. He's like, the
Mm,
wedding's, you can deal with that.
no, well, everything just gets harder from here.
Yes, yes. Oh,
Yeah.
well, what is new in your life?
Um, not. I feel like not a whole lot. We just had the event last week,
The
of
Top Golf.
Top Golf event. Yes,
Yes.
and it was a success. We had some
Woo!
good fun playing some golf and a Top Golf, I guess, a driving range, uh, type of golfing. And yeah, Keith Gangle was over and met with our clients. He did amazing. The food, Top Golf food, I think it's so underrated.
Yes.
That is such great food. It's probably some of the we have barbecue, American barbecue,
Okay.
and some of the brisket was falling off the bone. It was great.
Oh,
So everything
okay.
could and it could not have gone better.
Well, so why didn't I get an invite?
Yeah, that's what I'm saying because there is multiple people from your office at our event, which our clients got to meet. Uh,
Well, I think next time we need to really solidify that guest list and
mhm.
make sure we put some important people in there.
Exactly. You need to have a conversation with Tony.
Yeah, for sure. For sure. Well, I'm glad it was so much fun. I heard all about it, and I know Keith was really, really excited, Keith Gangle, and
Mhm.
it was Top Golf. It just sounds like a great event. So I'm glad it went off very, very well.
Yeah, thank you. And also, but based off of what you mentioned about you just getting engaged, it kind of ties into what we're talking about today.
Yes.
Today, we're going to be talking about the essentially just discussing the Federal Reserve cut interest rates. So, what does that even mean, right?
Yeah.
And the biggest thing that I will say, it depends. I mean,
Mhm.
it's not a short answer, and what it'll mean for you, Jaclyn, is going to be different from me, and then from even our regular clients that are
Mhm.
already in retirement.
Mhm.
But first, what actually happened? The Federal Reserve did cut the interest rates by 25 basis points, which in that's fancy word of saying a quarter of 1%.
Okay.
Um, and they called it a risk management cut because they still have concerns about inflation going up due to the tariffs, but and also but also on the other hand, unemployment is taken up a little bit.
Yeah.
So the and by the way, just to educate everyone on what the whole job of the Federal Reserve is to maintain stability, price
Mhm.
stability, and stable job market. Okay, so price stability means inflation. So essentially controlling inflation.
Mhm.
So if inflation is coming up, and unemployment is coming down, unemployment is coming up, they kind of work at against each other. So
Mhm.
that doesn't necessarily mean that, that they're going to cut interest rates, but they wanted to do it anyway just because they were concerned about the jobs, that reduction that has been. But they're kind of in a pickle because both labor, supply of labor and demand for labor has decreased. So it's kind of in a
Yes.
confusing time for the Federal Reserve to be cutting interest rates or even thinking about increasing interest rates at all. Um, but they did it anyway, more of a as a risk management cut, right?
Okay.
Uh, and so they decreased the federal funds rate by 25 basis points, right? And what does that even mean, right? It means that the banks and the Federal Reserve, they all lend money to each other, right? And then the big banks lend it out also. So essentially, how much does it cost for these banks to lend money out, right? So it's costing them 25 basis points less now. Okay. So
So,
therefore, they're going to lend more money out.
yeah. So will this affect interest rates?
Yes. Overall interest rates everywhere.
Okay.
That means money market interest rates, CD interest rates, T bill interest rates,
Mhm.
mortgage rates. Everything is all tied together. Right.
Wow.
So because it affects all of those things, and also another thing, it affects corporate lending rates, right? Which
Okay.
companies, when they want to grow, they sometimes don't have the capital on hand, the money
Mhm.
to fund whatever projects they want to grow. They don't have it on hand, so they have to go get some lending from the public or from the banks, right? So the cheaper it is to get this loans from the bank to the people or whatever,
Mhm.
uh, the the better that they can grow, the faster they can grow, and that's why when the Federal Reserve cuts interest rates, you typically see the stock market go up, which you saw that because that means it's good for companies.
Okay.
All
But
right.
then it isn't as good for your investments. Or
Well,
sorry, for your, like, CDs and
right.
long-term growth, stuff like that, because the interest rates go down on those, correct?
Well, and on the money markets and the
Yes.
CDs, those would be affected negatively
Okay.
because the interest that you earn from those are directly tied to the interest rates. So if interest rates come down, the what you make on those CDs and money markets come
Mhm.
down with it.
Okay.
So we've seen it. I mean, last year it wouldn't be too crazy to see a CD that was paying 5% plus.
Mhm.
And same thing with the money market. Money markets were paying 4.5, maybe 5%. And then over the months that the Federal Reserve cut interest rates, you saw those yields, those interest rates, coupons
Mhm.
decrease. And now you'd be lucky if you get anything above a 4% on a money market.
Oh,
Right now, I
wow.
think the average that I've seen is 3.5. It depends on what bank you go with. And then CDs are hovering around 3 to 4%,
Okay.
uh, and uh, and it's just going to keep coming down, right? And another
Wow.
thing I like to point out is that sometimes on the mortgage, car lending,
Mhm.
that kind of world, these interest rates take a little bit more time to get to that to affect those
Okay.
loans, because monetary policy has a lag. That's what we call it in economic theory. Uh, in Monetary policy takes about 3 to 6 months for it to affect not the only the economy, but also the loans, the mortgages, the auto loans, the
Mhm.
corporate lending. Sometimes that's how long it takes for it to see for you to see a change. And I'm saying that because a lot of people, as soon as the Federal Reserve cut interest rates, they give me a call and they say,
Yeah.
"Hey, should I go buy a car and finance it?"
Yeah.
And I'm like, "Well, give it a second, or refinance anything."
Yes.
Sometimes it makes sense then, sometimes not, right? And
Okay.
I think but typically a rule of thumb, and I use it on my own finances. I give it when there's a cut, and I like where I would be once the cut is effective on my interest rates. I wait about
Mhm.
3 to 6 months because most likely it's going to really show on the interest rate discount.
Okay.
So anybody that is listening and thinking, "Hey, I probably should refinance," wait just 3 to 6 months. and
Okay.
then you're going to see the full effect of it.
Yeah. And this is, I mean, this is a scary time. I mean, we're talking about pretty important topics that have been brought up in the last couple months, and it's going to be affecting all of those. But the one topic that you mentioned that I'm more curious about is the housing market.
Hmm.
Because for myself, as you just mentioned, getting engaged, we do not live together and we do not have a house. So what do you recommend for me, Jose? How should I go about this?
Well, I mean, that is a big can of worms, and and that alone will probably be a whole podcast in of itself. But how is this going to affect you? So, uh, obviously there's so many variables, but trying to keep things simple and using economic theory, because I like to think about
Yes.
things in that way because I'm an
Yes.
economist. So when the Federal Reserve decreases interest rates, it costs less for you to get a loan, a mortgage,
Okay. Okay.
right?
Mhm.
So let's say well, just leave it at that. It costs less to get a loan for a house, to get a mortgage. But on the other side, because it's more accessible to buy a house, what tends to happen is that demand for housing goes up.
Yes.
And what happens because of that? Prices of houses go up as well. So yes, it's cheaper to
Oh.
lend, or yeah, to ask for a loan,
Mhm.
but now houses are more expensive because there's more demand.
Mhm.
And you see that there's this everything else equal, right?
Mhm.
Just put it all into a vacuum. That's sometimes how that the majority of the time that's how it works.
Okay.
So use that with with the rule of the grain of salt, and so you what could happen is that you are gonna most likely have a higher likelihood of getting approved for a large loan,
Mhm.
but it doesn't mean you can afford that large loan.
Yes. Oh, I
Yeah,
know. Houses
yeah.
right now, man. But I mean, to stay on the positive side of things with this is I think the housing market is shifting a bit. I mean, I
Hmm.
am seeing personally a few houses that are staying on the market longer,
Hmm.
and it gives me hope, at least personally, because I don't have money to put down on a house for cash, right? I mean, I don't
Hmm.
have cash to do that. And so that was
Hmm.
the housing market a year ago. That was you didn't really get approved or get a house because they were selling for more than asking. And
Hmm.
so it's nice to see that in a way, but
Hmm.
you brought up very good points that it's a balancing technique, and knowing exactly when to act on it is going to be the tricky question. And that's what you're talking about with all of this, with
Hmm.
refinancing and making sure that you're talking with that financial advisor, and because there's so many variables in the situation.
Right, and it's all about keeping a pulse on it as well. Because, for example, I'll
Mhm.
use an example on me. I got a car
Mhm.
with and I didn't stress too much about the interest on the car
Can
loan
you share what
because
car?
Jeep Gladiator.
Oh, okay.
I love that thing. It's my dream car. Uh, but I wasn't stressing too much when I got it as far as the interest rates, because I knew from my economic analysis knew that the
Mhm.
Federal Reserve was going to decrease interest rates. And
Okay.
actually, the Federal Reserve has decreased interest rates 4 times since I got that car.
So have you
So
refinanced?
not yet, because I wanted to wait for this last little one, and then
Okay.
I should have by now I should have a whole percent difference uh, in
Wow.
it. Because if I did it after the first one, it would have been just a quarter of 1%
Yep.
discount. So I wanted to wait just I mean, it didn't even happen I mean, it happened in 1 year, so it was fine. It wasn't the interest damage wasn't a whole lot, but I
Mhm.
wanted to wait for that full percent discount or decrease, and
Yeah.
now I can refinance. But again, my using the rule of thumb that I mentioned earlier on myself, I'm gonna wait about 3 to 6 months
Okay.
to
Okay.
actually submit the refinancing application, because you don't want to do this every 3 months or whatever, because it's just going to be hitting your credit every
Okay, so
time.
that's what I was gonna ask. So
Yeah.
you are able to refinance more than once, but it's just a pain in the butt and your credit
Yeah,
goes
it's
down.
not something that you want to
Okay.
do.
Okay. Yeah, so
um,
again, another balancing act. Come on,
yeah.
give me some other information other than this.
Yeah, well, that's why we are a huge asset to our clients, because
Yes.
there's so many, on this hand, this is what happens, on this other hand, this is what happens. How do I make a decision? And that's kind of where we come in and kind of take in your goals and your
Mhm.
particular situation, and then apply it to this balancing act of different variables. For example, in your particular case with buying purchasing a house, maybe in the future,
Yeah.
yes, we have the balance of, yeah, interest rates come down more, so it's cheaper, but prices go up. But at the end of the day, it's going to come to your personal finances, where uh, can you afford the mortgage payment? Can you
Yes.
afford, what if something happened to the house right after you purchased it? How does that look like? So you want to own a house, but you don't want to be house poor.
Yes.
And that's the biggest advice I've been giving everyone around,
Mhm.
30, whenever they're buying the first house, which is
Yeah.
typically around the 30s. Um, Actually, over the years, there's a study saying that the person the buying their first home is going, the
Up.
age that they buy the first home is going up, 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 up. It's reaching
Yes.
almost average, almost 40 years old,
Mhm.
which is that's the kind of world we live in.
Yeah.
But anyway, the other way that this could affect somebody is, let's say, in they're in the retirement. We talked about what happens, somebody in
Yes.
the accumulation phase like yourself, and then what it looks like. Let's see what it looks like on the person that is already retired.
Mhm.
Most of the time, these kinds of people don't not necessarily have a whole lot of debt. That
Mhm.
their mortgage payments, majority of the time, it's almost all paid off, right?
Mhm.
And most likely they got a mortgage when interest rates were nothing.
Yes.
Um, and so it doesn't even make sense to refinance, right? So,
Or move.
or or
I
move,
mean,
because then they would have to most likely get a loan, and this loan is going to be
yes.
way more. Yes, so that happens too. So typically, these kinds of people have money in CDs. They tend to
Mhm.
be more conservative, so they're in CDs, money markets, things that pay, a really good interest rate, um, ongoing, and it's safe
Mhm.
because it's insured, right?
Yeah.
Uh, and it has been the holy grail for the past couple of years, because of, again, so much in interest rates. But now that's going to end. That's going to keep coming
Okay.
down. So these investors that are in retirement, they're going to have to find somewhere else to put the money,
Mhm.
because it's no longer going to be feasible, because you're not going to be able to keep up with the inflation. So, and the markets are going to keep booming,
Okay.
because interest rates going to come down. That means corporate lending is going to increase, and then companies are going to grow, right? Because they're going to
Okay.
have more money. So that's why the stock market does better, but CDs and money markets don't. So that is something that I would recommend, to get with your financial advisor, or us, and then we can think about, okay, how does this all affect my personal investment
Mhm.
strategy, financial planning? Does it make sense to move some of those assets that were giving me great
Mm.
interest rates back in the day when interest rates were high? But now that we see this trend of interest rates coming down, I'm going to have to find something else, somewhere else to put it.
Mhm.
So we have some other options that are just as safe, or that if you were relying on this coupon and this interest rate, we have that also.
Yes.
Um, right
So,
now,
yeah,
sorry.
sorry, I just have one more question for you. So you mentioned that companies are growing and stocks are, also growing. So my question is, do you think the employment rate and the job market is going to become better? Because I know you kind of mentioned that, but the job market is not fantastic right now.
Hmm, hmm.
And so do you think that that will have a correlation or relationship?
It's it's right now, it's in let's wait and see,
Okay.
because of these two big things: interest rates, the Federal Reserve, to see how much they decrease interest rates and how fast, and also these tariffs. See how long. See if, well, for one, if they're
Mhm.
legal. The Supreme Court is in the process of figuring out if they're
Okay.
legal,
Mhm.
because if they say yes, they're legal and they're going to stay on, that means that it's going to cost more money for companies to do business.
Mhm.
right? Because they're the company, the American companies are the ones that pay the tariffs,
Mhm.
right? So that's why it costs less. I'm sorry, it costs more for American companies to do business.
Yes.
Um, so those are the two biggest things that I'm looking at. I'm waiting to and
Okay.
seeing.
Okay.
uh, but we are seeing a slowdown in the job creation, but also
Mhm.
we're seeing a slowdown in the demand of
Mhm.
jobs. Um, like I said, supply and demand on both sides of the curve are coming down at the same time.
Mhm.
Part of it is, it could be due to immigration, the
Okay.
decrease in immigration, the deportations that have been happening, and also it could also be the tariffs that it's
Okay.
costing more to do business. So they have to dial it down. They have to do some cost cutting. They just Starbucks just went on the news and they're cutting $1 billion from their business and they're closing down a lot of their stores. Yeah,
Wow.
so that is just one example of, and Microsoft, I believe, also did the same thing.
Mhm.
But their reasoning is because of AI. A lot of the jobs are being replaced by AI.
Mhm.
But there's so many variables right now. There's so many things that we're watching and we're keeping a pulse on because it will
Mhm.
affect everybody, and that's what we do on a daily basis. I'm in contact with Keith,
Yeah.
and I'm in contact with Alex Hill, which has been on the show,
Mhm.
and get his input. Yeah, because he's a economics professor, my former economics professor, which you haven't
Wow.
had a chance to meet, but he was on the show a couple times, and I get in contact with him and I say, hey, what's going on? I mean, these are my thoughts. Am I crazy for
Mhm.
thinking this way? And so it's just sounding boards and get all these very smart
Yes.
individuals and just make sure that I'm as educated as I can be.
Yeah, you guys have a fantastic team. The way that you guys work together and the way that you bounce ideas off of one another and you really strategically plan for the future and what might come
Hmm.
and yeah, I love that you guys have that teamwork.
Yeah, we the way we like to think about it is that we can't predict the future, but we can prepare so the element of surprise is not
Mhm.
there because
Yeah.
we're proactively thinking about what could happen.
And when did these rate cuts happen? So they happened,
Ooh,
do you
a
have a
couple
date on
of
that?
let's see, 2 weeks ago.
Okay.
It happened on Tuesday, exactly today, 2 weeks ago.
Okay. Okay.
Because I was
So,
there. I was in Minnesota when it happened, and it actually was pretty interesting because I was there to talk with all the money managers and all the Wall Street people.
yes. So I believe the 16th of September is
Hmm.
when this happened. And so we're still seeing a lot of effects and there's still going to be a lot of changes to happen.
Hmm.
And like you said, I mean, the 3 to 6 months, to even a year ahead,
Hmm.
there's going to be several changes that continue to happen. And staying in contact with your financial advisor and staying in contact with you, Jose, I will definitely be doing that and staying on top of things before we jump into buying a house.
Hmm.
And so, Jose, how can our listeners get a hold of you?
Yeah, they can give us a call at 888-390-5277 or go to the podcast website, financialarmorshow.com, or our company website, cooperfinancial.com, and schedule a no obligation, no cost consultation with me or Brad, and we can answer your questions.
Yeah, there's several that I have, and hopefully we got many questions answered for our listeners. But feel free to give them a call as they will be able to just dissect your circumstance in individually. So I appreciate you, Jose. Anything else before we take a take be done for today?
I think that's all I got. Thank you so much for joining me.
All right. That does it for this episode of Financial Armor with our host, Jose Rodriguez.